Hello friends, welcome to my YouTube channel Simply Stocks, and today I'm going to talk about the reasons for the mid-cap carnage and what lies ahead for the market. So let's get started. Well, as we have seen since January of this year till now, the mid-cap and small-cap have fallen more than 20%, nearly 20 to 23%, and this fall has been more than what we have seen or witnessed in the Chinese crisis of March 2016 or during demonetization in November 2016. So what has led to such a major fall in especially the small and mid cap stocks? Well, the first and foremost reason for that has been the increase in cost of capital, which is the increase in interest rates. And it was inevitable that India would increase interest rates once the economy in the US and Britain, Europe, etc., started to improve and the interest rates went up there. And once that happened, the mid cap and small cap will feel the heat because it was the decrease in cost of capital which started from 2013 with the quantitative easing in the United States that this small cap rally started. And once that has reversed, it was inevitable that the stocks would reverse again. Another reason for that has been the booming rally of 2017. We have seen the small cap index go up 65% from January 2017 till Jan of 2018, and there is always a reversion to mean by the stock market that takes place once we have such a booming 1 year. So this year had to be one of sideways for all the indices, be it the Nifty or the Sensex, or for that matter the mid cap or the small caps. Another thing I want to point out is that during the fall of 2016, the benchmark indices itself fell 20 to 22%, and hence the gash was felt more by all the investors compared to what has happened in the current fall, in which the Nifty, even the Bank Nifty and the Sensex have been resilient and actually have performed much better compared to the mid cap stocks, and hence we don't feel the same fear as it was during 2016. I remember the volatility at that point of time, the India VIX reached to a level of 23-24, whereas currently it is hovering around 13-14. Another major reason for the fall has been the below par earnings of both the Nifty stocks as well as the mid caps. Analysts have expected 15 to 20% growth rates for the benchmark indices, and we have not seen that happening for the last 8-10 years, let alone the past 1 year. And this has been a major reason and cause for concern for all the investors in the Indian stock market. So, what lies ahead? Well, as far as I am concerned, I feel the fall may be at the cusp of bottom for the moment. Looking technically into the charts of the small cap indices and also the bank nifty, etc., it looks like that we could be somewhere around the bottom, although the rise might not take place immediately, but it will take 2-3 months, 4 months down the line, and by the time Diwali comes or at the end of the year, we could be having a situation in which we could have moved up 15-20% from the current range that we have been stuck in, especially in the small caps. We could have a scenario in which especially the benchmark indices like Nifty or the Sensex will remain range bound for the next 3-4-5 months, and the year could go by in a range bound fashion. But come 2019, we could have a booming rally again. So what I feel is investors should stick with their positions and stay put. If they don't have the money, don't invest more into the market, but don't take out your money as well, because this is the time where you need to show resilience and stick to your guns and stick with your positions if you have conviction with the companies that you're holding. Markets require fresh triggers to move, so it doesn't happen like one day you get up and the market starts moving up. It requires triggers either from global indices or global markets, say some good news coming from the United States with the trade war that they are having with China, or in that case from India itself, in terms of elections, say local elections or the general elections that would be up in about 1 year time. So markets require trigger in order to move either upwards or downward. There could be negative news as well, in which the market could fall, the major indices could fall 10-15%. So that's what we all are waiting for, major triggers. The up move could be equally unprecedented. There's no doubt about it, and that is what has happened over the times whenever there has been major falls in the market. And 20-22% wiped out from the indices itself, with stocks going down 40-50%, is a major gash in all respect. Hence, I believe the up move could be huge whenever it starts, whether it starts by the end of the year or next year. It could be equally unprecedented, and we could see a 60-70% move in the small cap index itself, and stocks could still go up 1.5 to 3 times again. So there is no question whatsoever that this market is not in a bear market situation at all. If it were a bear market, then we could have had the Nifty and the Sensex going down 20-25%, but that has not happened. So hence we need to be patient at this point of time. This more or less seems like the situation of 2013 rather than 16, in which the benchmark indices were fine. It was hovering around 5,000, 5,200, and the fall was around maximum 10-11% on the Nifty. But the small cap and mid cap were butchered at that point of time, and we all know what happened from March of 2014 till now. It has been a 3-4 years of unprecedented rally in the small and mid caps, and there has to be reversion of mean, and the stocks coming to a slightly reasonable levels, and the froth going down. That had to happen, and it has happened over the last 6-7 months. Hence I believe the investors who are stuck in positions with good mid cap stocks, with good small cap stocks, consumer stocks especially, should stay with it and ride the tide right now. And with good comes some bad as well. So when the going was really good, you made money. At this point of time, you have to be resilient and stick with your guns. Thanks for watching, and please like and subscribe my channel. Thank you.